Predatory lending, helping you to avoid becoming a lender's prey. Materials provided by Genesis Financial Management. Introduction to predatory lending. Predatory lending strips billions in wealth from low-income consumers and communities in the U.S. each year. Borrowers lose more than $25 billion annually due to predatory mortgages, payday loans, and other lending abuses like overdraft loans, excessive credit card debt, and tax refund loans. What is predatory lending? Predatory lenders are lenders who get away with charging inflated fees and interest rates. They take advantage of the fact that most people don't care enough about their financial affairs to read and understand certain offers. They write their terms in a way that confuses the consumer rather than explain. Predatory mortgage lending. Is purchasing that house really a good deal? A typical predatory mortgage is a refinance of an existing loan that is packed with excessive or unnecessary fees and provides no tangible benefit to the borrower. Unfortunately, many of these loans are perfectly legal, and too often they are targeted at some of our most vulnerable citizens. Robbing families. Predatory mortgage lending drains wealth from families, destroys the benefit of home ownership, and often leads to foreclosure. The Center for Responsible Lending estimates that predatory mortgage lending costs Americans more than $9.1 billion each year. Where does it happen? Most abusive lending takes place in the subprime market, targeting people with weak or blemished credit records. What are subprime loans? They are higher-priced loans made to a borrower with high-risk factors such as low credit score, a history of late payments, or even bankruptcy. A predatory lender makes loans the buyer cannot pay back with the intention of taking the property or stripping its equity. Equity stripping. Equity stripping occurs when a loan is made based on the equity in the property rather than on the borrower's ability to repay the loan. As a general rule, loans made to individuals who do not have the income to repay such loans usually are designed to fail. They frequently result in the lender acquiring the borrower's home and any equity the borrower had in the home. Common abuses. 7 signs of predatory lending. Here are some of the most common abusive practices predatory mortgage lenders use. 1. Excessive fees. 2. Abusive prepayment penalties. 3. Kickbacks to brokers, yield spread premiums. 4. Loan flipping. 5. Unnecessary products. 6. Mandatory arbitration. And 7. Steering and targeting. Let's talk about excessive fees. Points and fees are costs not directly reflected in interest rates. These costs can be financed and are easy to disguise or downplay. On competitive loans, fees below 1% of the loan are typical. On predatory loans, fees totaling more than 5% of the loan are common. Abusive prepayment penalties. Borrowers with higher interest subprime loans have a strong incentive to refinance as soon as their credit improves. Up to 80% of all subprime mortgages carry a prepayment penalty, which typically affects more than 3 years and/or costs more than 6 months interest. In the prime market, only about 2% of home loans carry prepayment penalty of any length. Kickbacks to brokers, yield spread premiums. When brokers deliver a loan with an inflated interest rate, for example, higher than the rate acceptable to the lender often pays a yield spread premium, which is a kickback for making the loan more costly to the borrower. Loan flipping. A lender flips a borrower by refinancing a loan to generate fee income without providing any net tangible benefit to the borrower. Flipping can quickly drain borrowers' equity and increase monthly payments, sometimes on a home that had previously been owned free of debt. Unnecessary products. Sometimes borrowers may pay more than necessary because lenders sell and finance unnecessary insurance or other products along with the loan. Mandatory arbitration. This means the borrowers are not allowed to seek legal remedies in a court if they find that their home is threatened by loans with illegal or abusive terms. Mandatory arbitration makes it much less likely that borrowers will receive fair and appropriate remedies in cases of wrongdoing. Steering and targeting. Predatory lenders may steer borrowers into subprime mortgages, even when the borrower could qualify for a mainstream loan. Vulnerable borrowers may be subjected to aggressive sales tactics and sometimes outright fraud. Fannie Mae has estimated that up to half of borrowers with subprime mortgages could have qualified for loans with better terms. Payday lending. Does a payday advance really work to your advantage? Payday lending, sometimes called cash advance, is a practice of using a post-dated check or electronic checking account information as collateral for a short-term loan. Borrowers need only personal identification, a checking account, and an income from a job or government benefits like Social Security or disability payments to qualify. Payday lending is designed to keep a borrower in debt, not to provide one-time assistance during a time of financial need. Studies show that 91% of the payday lenders' business is made up of borrowers who receive 5 or more loans a year. For a 2-week payday advance, a borrower will pay at least $15 for every $100 borrowed. Cost of a payday loan. With such a short duration, these loan fees are equal to roughly 400% annual percentage rate. Consumers who renew their loans often end up paying more in fees than they have borrowed. Studies estimate that predatory payday lending practices cost American families about $3.4 billion annually. 9 signs of predatory payday loans. Triple-digit interest rates. Payday loans carry very low risk of loss, but lenders typically charge fees equal to 400% annual percentage rate and higher. Short minimum loan terms. 75% of payday customers are unable to repay their loan within the 2 weeks and are forced to get a loan rollover at additional cost. In contrast, small consumer loans have longer terms. In North Carolina, for example, the minimum term is 6 months. Single balloon payments. Unlike most consumer debt, payday loans do not allow for partial installment payments to be made during the loan term. The borrower must pay the entire loan back at the end of 2 weeks, with interest. Loan flipping, extensions, rollovers, or back-to-back transactions. Payday lenders earn most of their profits by making multiple loans to cash-strapped borrowers. 90% of the payday loan industry's revenue growth comes from making more and larger loans to the same customers. Flipping occurs when a lender induces a borrower to repeatedly refinance a loan, often within a short time frame, charging high points and fees each time. Simultaneous borrowing from multiple lenders. Trapped by the debt treadmill, many consumers get a loan from one payday lender to repay another. The result, no additional cash, just more renewal fees. No consideration of borrowers' ability to repay. Payday lenders encourage consumers to borrow the maximum allowed, regardless of their credit history. If the borrower can't repay the loan, the lender collects multiple renewal fees. Deferred check mechanism. Consumers who cannot make good on a deferred post-dated check covering a payday loan may be assessed multiple late fees and non-sufficient fund check charges or fear criminal prosecution for writing a bad check. Mandatory arbitration clause. By eliminating a borrower's right to sue for abusive lending practices, these clauses work to benefit the payday lenders over consumers. And last but not least, no restriction on out-of-state banks violating local state laws. Federal banking laws were not enacted to enable payday lenders to circumvent state laws. Alternatives to payday lending. A payment plan with creditors. Advances from employers. Credit counseling. Emergency assistance programs. Overdraft protection at a bank or credit union. Credit union loans. Cash advances on credit cards, military loans, small consumer loans. In summary, predatory lending doesn't stop at mortgages and payday loans. It can happen in any type of lending, from buy here, pay here places to pawn shops to car title loans, and advance fee loans. Even credit cards can have predatory lending terms. Look for alternative methods and don't be pressured. The right loan for the lender may be the wrong loan for you. Questions, comments, concerns? For more information on predatory lending, or if you have any other financial questions, you can call us at 877-202-9246 or visit us at www.yourgfm.org.